Most people having a gambling tendency are fascinated by intraday and short term trading, which provides a certain level of excitement, focusing on the intraday and daily charts. Most people overlook the fact that the big money in the market and the huge explosive trades are in the longer swings, for which weekly charts are a must. Our topic today addresses this oversight and focuses on the longer term weekly chart to generate profits which serious traders, institutions, high net worth individuals, and pension funds use to generate humongous amounts of money without the least bit of tension. So today we are building, displaying, and interpreting an adaptive weekly MACD trading strategy with enforced alternating buy and sell signals displayed so that you can see whether the signal performance is statistically meaningful. The system is valid on stocks, commodities, futures, and cryptocurrencies. A quick roadmap of what we intend to cover is what is an adaptive MACD, the alternative signal rule, and the usage on real world charts. The system is best adapted to traders who are long term swing traders and want to catch huge moves and make big money in the markets. Please watch till the end of the video to get the full advantage of this powerful technique where we give you the Pine 6 code which you can adapt directly onto any chart and make use of this powerful system. So let's begin. The standard MACD is a static signal with the signal line equal to 12 EMA minus 26 EMA and the trigger line equal to the 9 EMA of the signal line. This was formulated by Gerard Appel. For the adaptive MACD, we will replace the standard EMA with the KAMA, the Kaufman's adaptive moving average, so that the fast and slow lines adapt to the changing volatility. We take MACD equal to the KAMA fast minus the KAMA slow, and then a KAMA smoothed signal line. Please remember that since the MACD is a moving average based indicator, it is confirmatory and not predictive in nature and is therefore a lagging indicator. The lag in the indicator, even though a disadvantage, gives a greater confirmation to a generated signal. By the way, if you're finding this helpful, we have just launched our live technical analysis course on www.chartinfo.org. If you want to understand how to analyze a chart perfectly and convert an analysis into a profitable trade and actually apply what you're learning to the markets, this would be an ideal course for you. We cover everything from price action trading and indicators to trading methods and systems in our own unique way. And it's all interactive, so you can clarify doubts in each class. Definitely check it out at the website if you're ready to level up. Now back to the video. The Kaufman Adaptive Moving Average or KAMA is an adaptive technical indicator that adjusts its calculation speed based on market volatility using a three-part formula. The KAMA, which is equal to the KAMA of the previous period plus a smoothing constant multiplied by the difference between the price and the KAMA of the previous period. To calculate the smoothing constant, we first find the efficiency ratio, which measures the signal's direction and noise. The efficiency ratio determines how much the KAMA adapts using a fast and a slow moving average smoothing constant to get the final smoothing constant. An important rule to remember is that to reduce noise and overtrading, we require alternating signals. That is, we take only a buy if the last executed signal was a sell, and we take only a sell if the last executed signal was a buy. This ensures that sequential signals alternate and prevent repeated re-entries in the same direction. Here are some examples of this system in action. This is a chart of Bitcoin versus the US dollar. Being the weekly chart, you can see that the moves which are being shown on this chart are huge, and the signals which have been appearing on the charts are almost cent percent correct. There are certain instances where the signal may appear in a trading range, but by and large, you can see that the trending section of the market results in humongous profits in each of the signals. The second signal is in the S&P Nifty index futures, where again, based on the weekly chart, you can see that the movements are in thousands of points with each signal. Every single signal is correct in this move. The third example is on the State Bank of India futures, where we had a trading range where the signals were of an average nature. But look at this move here, where the system caught an almost doubling of the stock within a short period of time. All of the remaining signals are correct in their interpretation. Finally, we look at the chart of TCS, where again we find huge down moves which have been caught by this system, and certain up moves which were caught, although not with such precision. The Pine 6 code for the system is in the comments, which you can paste in the Pine editor and check out. Finally, a short disclaimer. This is an educational code and not financial advice. Please make sure that all trades which you do based on this system are certified by a professional portfolio manager. Backtests are dependent on data, time frame, look back, and survivorship biases. Test with realistic commissions, slippage, out of sample, and walk forward analysis before risking your capital. Thank you for watching this video, and all the best till we meet soon again in another video.